Sri Gurubhyo Namaha children. We welcome you to our online teaching academy Ekalaiva. Today we are going to start our new lesson in economics, unit 4, cost and revenue analysis. The big hurdle is going out and raising the revenue. So the big task of every human being is going out and raising our revenue. This is a famous quotation given by Tyler Cowen. So first you should know what is meant by cost. For example, if you are going to a shop and if you want to buy something, so you have to spend. So that is cost. And revenue, for example, if you are running a business, if you are selling a product or a commodity, the income that you earn by selling that product, it is called as revenue. So in this chapter, we are going to discuss about cost and revenue, how we are going to analyze, calculate the cost and revenue. We are going to discuss in this lesson. First, introduction. Cost and revenue analysis refers to examining the cost of production and sales revenue of a production unit or firm under various conditions. The objective of a firm is to earn profit and not to make loss. However, a firm's profit or loss is primarily determined by its cost and revenue. If we take in simple terms, profit or loss is defined as the difference between the total revenue and total cost. That is, profit or loss equal to total revenue minus total cost. So here you can see, in common sense, profit or loss is calculated by subtracting total revenue minus total cost. So as cost and revenue are very important to decide the production of a firm and its supply behavior in the market, it is necessary to understand the cost and revenue concept. Next we are going to discuss about cost analysis. So first, costs refer to the total expenses incurred in the production of a commodity. How much you are going to invest in the production process of a commodity. So that is called cost. Cost analysis, it refers to study of behavior of cost in relation to one or more production criteria. So namely, you can take size of output, scale of production, prices of factors, and other economic variables. So the functional relationship between cost and output is expressed as cost function. So here you can see C equal to F of Q, where C is cost and Q is quantity of output. So cost functions are derived functions because they are derived from production functions. Now we are going to discuss about cost concepts. In that first we are going to discuss about money cost. Production cost expressed in money terms is called as money cost. In other words, it is the total money expenses incurred by a firm in producing a commodity. Money cost includes the expenditures such as cost of raw materials, payment of wages and salaries, payment of rent, interest on capital, expenses on fuel and power, expenses on transportation, and other types of production related costs. These costs are also called as out of pocket expenses prime cost, direct cost, nominal cost, accounting cost, or explicit cost. So these are all the various names for money cost. Now we are going to discuss about real cost. Real cost refers to the payment made to compensate the efforts and sacrifices of all factor owners for their services in production. It includes the efforts and sacrifices of landlords in the use of land, capitalists to save and invest, and workers in foregoing leisure. So Adam Smith regarded pains and sacrifices of labor as real cost of production. Next, we are going to discuss about explicit cost, which is otherwise known as paid out cost. So payment made to others for the purchase of factors of production. Already you know what is meant by factors of production. For example, land, labor, capital, everything comes under factors of production. It is known as explicit cost. It refers to the actual expenditures of the firm to purchase or hire the inputs the firm needs. So explicit cost includes wages, payment for raw material, rent for the building, interest for capital invested, expenditure on transport and advertisement, other expenses like license fee, depreciation, and insurance charges. Explicit cost is also called as accounting cost or out of pocket cost or money cost. Next, we are going to discuss about implicit cost. So implicit cost or otherwise called imputed or book cost. So payment made to the use of resources that the firm already owns is known as implicit cost. In simple terms, implicit cost refers to the imputed cost of a firm's self-owned and self-employed resources. So a firm or producer may use his own land, building, machinery, car, and other factors in the process of production. So these costs are not recorded under normal accounting practices as no cash payment takes place. Because he is not going to pay for the land which he is using, or he may use his own car for the production process. So he is not going to pay any amount for that. So, however, the value of the own services are imputed and considered for preparing the profit and loss account. The implicit cost is also called as imputed cost or book cost. Next, we are going to discuss about economic cost. It refers to all payments made to the resources owned and purchased, or sometimes the person may hire. So it is the summation of explicit and implicit cost. So it is very helpful to calculate the normal profit and thereby the economic profit of a firm. So economic cost is equal to implicit cost plus explicit cost. Next we are going to discuss about the social cost. Social cost, it refers to the total cost borne by the society due to the production of a commodity. So Alfred Marshall, he defined the term social cost to represent the efforts or sacrifices undergone by the various members of the society in producing a commodity. Social cost is the cost that is not borne by the firm but incurred by others in the society. For example, large business firms cause air pollution, water pollution, and other damages in a particular area which involve cost to the society. These costs are treated as social cost and it is also called as external cost. Next, we are going to discuss about opportunity cost. It refers to the cost of next best alternative. In other words, it is the value of the next best alternative performed. For example, a farmer can cultivate both paddy and sugarcane in a farmland. If he cultivates paddy, the opportunity cost of paddy output is the amount of sugarcane output given up. He has to give up. So opportunity cost is also called as alternative cost or transfer cost. Next, we are going to discuss about sunk cost. It is also known as retrospective cost. A cost incurred in the past and cannot be recovered in future is called a sunk cost. So this is historical but irrelevant for future business decisions. It is called as sunk because they are unalterable, unrecoverable. And if once invested, it should be treated as drowned or disappear. So, for example, if a firm purchases a specialized equipment designed for a special plant, so the expenditure on this equipment is a sunk cost because it has no alternative use. Its opportunity cost is zero. So sunk cost is also known as retrospective cost. Next we are going to discuss about floating cost. So it refers to all expenses that are directly associated with business activities but not with asset creation. So it does not include the purchase of raw material as it is part of current assets. For example, if you take payments like wages to workers, transportation charges, fee for power and administration. So floating cost is necessary to run day-to-day activities, that is day-to-day business of a firm. Next one we are going to discuss about prime cost. All costs vary with output together with cost of administration is known as prime cost. So prime cost equal to variable cost plus cost of administration. Next we are going to discuss about fixed cost and variable cost. So fixed cost does not change with the change in the quantity of output. So fixed costs remain constant, so it will not change according to the output. So expenses on fixed factors remain unchanged irrespective of the level of output. So fixed cost remains unchanged because it will not differ when the level of output decreases or increases. So example for fixed cost is rent of the factory, permanent workers' salary. So the other names for fixed cost are supplementary cost or overhead cost. Next one, variable cost. These costs vary with the level of output. It differs. When the output differs, the cost also will differ. For example, you can take wages of temporary workers, cost of raw materials, fuel cost, electricity charges. So there may be fluctuation in all these costs because according to the production, it may increase or decrease. So variable cost is also known as prime cost, special cost or direct cost. Now in this you can see we discussed the difference between fixed cost and variable cost in the previous slide. Now fixed cost, I told you it is also known as overhead cost, costs that don't vary with the sales or production levels. So example, executive salaries and rent. Here variable cost, it vary directly with the level of production. So example, raw materials. So total cost is sum of the fixed and variable cost for a given level of production. Okay children, today we discussed about different types of cost and different names for different cost, everything we discussed. Tomorrow we will continue about the revenue analysis. To receive our online lessons, please press the subscribe button and you will receive the latest updates. Thank you children.